What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC and GME update to bring all of you this evening. So what we're going to be covering in this update is a little bit of the technicals, the longer time frames on AMC. We're going to be talking about the Ortex data and any changes that we saw today, but we just received some pretty big news for GME. So we finally got more details on the stock split, what the actual split is going to be, and when these shares are actually going to be going out to shareholders. So we also have this other interesting situation with Credit Suisse. Now, if you remember about a week ago, we talked about the potential of Credit Suisse maybe having some issues with their financial condition and potentially going bankrupt in the near future. We have more data out on that today that smart money is betting that is going to happen, or basically confirming what we said in that previous video. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So AMC closed the day today down about 21 cents or 1.64%. Now, not necessarily what we wanted to see today. We did see the Fed minutes. We saw a lot of volatility. But again, taking a look at the longer time frame over here, let's just pull up AMC on this chart right here on the 5-minute. I have SPY up right here, but let's see AMC right now on this 4-hour time frame that we like to take a look at over here. Again, we did cross down on the 4-hour. So this is typically an indicator of bearish momentum or coming back down to the downside. But it is possible that we do see a little bit of a pop with this GME dividend news, which we're going to talk about in a minute. Now, again, if you guys do want more access to the 1348 trading strategy, all the live streams, all the trading algorithms, make sure you check out that link down below. Now, coming over here to the Ortex data, let me give this a quick refresh over here. We've got 20.76% max cost to borrow today. We have 14.98% on the average, and we have 3.14% on the minimum, with 17.63% live estimated short interest as a percentage of the free float. Now, shares on loan is continuing to go down, down about another 4 million today at 141.35 million shares on loan. So again, we are seeing shares supposedly get returned. We're going to have to kind of wait and see how this is going to really act going throughout the end of the week. But for right now, and the amount of time that these shares on loan have been decreasing, it does look like a recall, which we have been talking about in previous videos. Now, I want to get into this Gamestop situation here because this is something that a lot of people have been really excited about over the last couple of months. Gamestop board approved stock split plan, shares rise. July 6th, Reuters, GameStop said on Wednesday its board has approved a 4-for-1 stock split, sending the video game retailer shares up more than 5% in extended trading. The split will be in a form of a stock dividend, which will be distributed after markets closed on July 21st. So we're getting the dividend at the end of July. So this is going to get really interesting here. So we've seen a couple of these special dividends come out in the past. Again, I don't want to get everybody's hopes up saying that this is going to be the catalyst for a massive movement to the upside. Could it be? It absolutely can. But I think going in with cautious optimism in events like this is kind of the best route. Again, this definitely could cause a pretty significant move to the upside, especially if we start to see GME head up in this time before we see this dividend going to actually be distributed. But again, cautious optimism, in my opinion, is going to be the way. Now, I do want to talk about this Credit Suisse situation because this is really important for our broad markets here. And again, guys, if you haven't already, make sure you guys engage with the video, hit that like button down below, and honestly drop a comment on what you think is going to happen with this GME dividend in the form of or the stock split in form of a share dividend coming out at the end of July. Now, the first thing that we need to speak about is kind of why we were speculating that Credit Suisse was in trouble. And it's not really speculation. They kind of just blatantly came out and told us that they were kind of in poor financial condition. When we come over to this article right here, Credit Suisse ready for good risk opportunities, says new risk chief. Swiss bank moves away from cautious approach to pursue a more profitable business. Credit Suisse is once again preparing to take on riskier business after high-profile crises had prompted the bank to adopt a more cautious approach. according to the Swiss lender's new chief risk officer. Now, this article came out on June 28th. David Wildermuth, who joined from Goldman Sachs in January, said the bank was moving the pendulum back the other way after ditching riskier clients following the catastrophic events the business suffered last year. It's the second time in my career I feel I'm as much a cheerleader for taking on more risk as I am for reducing risk. The other time was right after the financial crisis. That's not really a vote of confidence for the new chief risk officer to be giving out to shareholders. As I'm going out and meeting clients and our teams, I think we do want to take smart risk where we really understand the risk. Oh, you guys have been great at doing that in the past, huh? We are aware of the risk and we understand the detailed outcomes of that risk. They're trying to restore investors' confidence after a bruising 18 months that exposed poor risk controls, left the bank with the biggest trading loss in history and hammered its share price. Last spring, the lender was hit by the twin collapses of specialist finance firm Greensill Capital and family office Archegos. However, its decision to rein in its risk-taking has hit revenues, leaving the bank under pressure to pursue more profitable business. So here's essentially what they're doing here. They're saying, hey, we are unable to generate the types of revenues that we would like to by essentially operating within the rules. So we are going to take on even more risk, hopefully, that is going to generate more profits for the business, but not enough risk where they're on the verge of collapse. The market in general right now does not believe this one bit. When we come over here and take a look at this chart, this is very, very interesting. Whoa, credit default swaps for Credit Suisse are going absolutely vertical. Insurance against the default of the $14 billion bank are approaching levels not seen since the great financial crisis. And we can see this chart right here. The credit default swaps are skyrocketing. Essentially what this means is that the amount of money in total that is betting against the success and essentially for the failure of Credit Suisse is absolutely skyrocketing. And they haven't seen these levels up at these levels over here since about 2011, 2012, or even back in 2008 and 2009. So the overall market is telling us, and these institutional investors are saying, hey, we do not believe that Credit Suisse is going to have a successful future at all. Now, as I'm going through some of this data here, it kind of popped into my mind, well, why don't we take a look at the actual short interest on Credit Suisse right now? If there's a lot of money betting against this company, essentially ensuring its collapse, well, there should be a lot of other money kind of betting against it in the equity market as well. Not necessarily. We see this live short interest over here as the estimate 0.5%. The last couple times the short interest as a percentage of free float came out 0.6%, 0.35%, 0.41%. And it hasn't really been above 1% in a very, very long time. So in the actual equity market, people are not really betting against Credit Suisse right now, but in the credit default swap market, they are. So that's a very interesting difference right there, that they have not kind of come after Credit Suisse in the equity market yet. The other thing that you got to think about here is what happened back in 2008. If there's a lot of big money betting against a bank, which happened in 2008, remember, one of the kind of biggest instances of naked shorting was against Lehman Brothers and Bear Stearns back in 2008. That pushed them into bankruptcy. If you start to see Credit Suisse's short interest start to come up in terms of the reported data, you can almost say for pretty much certain that a lot of these funds are going to start attacking this bank. So this is something that I want you guys to be aware of going into the end of the year. But that is going to wrap up this update on AMC, GME, and the stock split through a shared dividend and the situation unraveling with Credit Suisse right now. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great evening, and I will see you guys in the next video.